Is policy excessively restrictive in your view?
Certainly not. He's really focusing on the difference between the policy rate as it stands right now and his particular estimate of the neutral rate. If you look at financial conditions, if you look at financing costs, it's really difficult. If you look at asset prices, it's really difficult to make the argument that policy right now is excessively restrictive. Rather than orienting towards some sort of theoretical or abstract idea of what constitutes neutral, I think is more important and more practical to look at the actual consequences of the current policy rate on financial markets, on financial conditions, and on credit conditions. And there is nothing screaming in my face that financial conditions or the policy rate is too restrictive right now.
Is there anything, Stuart, in terms of his argument that kind of makes sense? I mean, he says he doesn't see enormous economic pessimism. I don't think the economy is about to crater. I mean, he seems kind of upbeat. I mean, does any of what he's saying make sense with kind of the U.S. statistics?
But wants to cut?
The U.S. statistics that you look at?
This is really, I think, the simplest way to square the circle if I'm Steve Miran and I want to make the argument for quick cuts. I would just basically say, look, policy rates today are where they were when nominal GDP growth was running at a pace closer to 7% per year. And now we're significantly below that. And if nominal economic activity, the dollar value of all goods and services that are produced during the year, if that growth rate has slowed, we might as well cut rates. I think that that's the simplest plausible explanation for what he's saying. But I think that the reality is that he does need to navigate a sort of difficult political path here where he needs to say, it's not the case that fiscal deficits are raising neutral. It's not the case that the labor market is cooling because ultimately I'm going to be going back to the White House and politically we need to orient the public opinion in favor of the current administration, especially ahead of the midterms. He has a very treacherous communications path that he needs to navigate. And when that's the case, he needs to sort of say, look, I want to juice the economy, even though it's not necessarily falling off a cliff. We want to just balance risks here.
Maybe he's going back to the White House.
Maybe he's going back to the White House. Look, I mean, he's just on a temporary unpaid leave right now, so he's expecting to go back to the White House.
As far as policy, how he views policy, we sort of got his view and where he stood compared to the other voting members last week. Everybody else, they voted along with Jay Powell for a rate cut of 25 basis points. He was by himself with the 50 basis point vote. Is there anyone else, though, who's emerged in recent days who's echoing what he's saying, or is he the only one with this rhetoric right now?
He's the only one who's argued for a series of 50s. That's an exceptionally bold line of argument. That's an exceptionally bold statement. We have seen folks like Mickey Bowman come out and argue for swifter cuts, but not a series of 50s. There is a contingent of doves that is becoming more vocal on the committee, that's for sure. But look, we knew that when we got the dot plot that showed that the median member was expecting 75 basis points of cuts this year. So there definitely are more doves on the committee, but none as dovish as Steve Miran.
What do we need to know about Federal Reserve Bank of Dallas President Lori Logan saying that the U.S. Central Bank should abandon the Fed funds rate as its benchmark in implementing monetary policy?
I think this is just more an evolution of monetary policy, and more particularly an evolution of monetary policy communications. It's really just to say that there is a big pool of money outside of overnight interbank lending that we need to account for when we're setting our target for the overnight rate. You have folks like Fannie Mae and Freddie Mac who have a lot of money that they can lend overnight. You have money market funds that have cash that they can lend overnight. And if we're thinking about the overnight funding rate, we should take into account those pools of money. So it's not really some dramatic shift here. It's a little bit of just an evolution of communication around Fed targets.
Okay, I want to shift gears a little bit because we got Stuart in here for a couple more minutes. He watches the economy and the consumer closely. He's U.S. and Canada economist for Bloomberg Economics. We're a little confused about the state of the consumer right now, and I'll tell you why we're a little bit confused. CarMax came out and said fallout from President Trump's tariffs and rising distress among consumers are why we are missing our numbers right now. Shares down as much as 20% in this session. Just in the last hour, we spoke to Rob O'Hare. He's CFO over at a firm, the Buy Now, Pay Later firm. Our first question to him was, how's the consumer doing? He basically said, everyone's great, nothing to see here. He echoed what Max Levchin told us, the CEO, a couple weeks ago. We're not seeing a rise in delinquencies. The consumer is strong. What's going on here?
When spending volume on a firm is especially elevated, to me, that suggests that consumers are feeling a little bit stressed and they need to finance some of the smaller everyday purchases that they would otherwise be making with cash. And if that's the case, I think it's actually in line with what we might be seeing from a firm, which is that folks just don't have the cash right now to spend on used vehicles.
But they're paying it back on time.
So
But the point that they need to take longer to pay for something, they can't pay for it right away.
Right, they can't pay for it right away. So it's not the craziest thing in the world to think that they could pay back a $100 loan for a sweater on time. But the fact that they can't outlay $100 and instead need to pay it off in $25 increments speaks volumes.
So you don't see these as conflicting narratives by any means?
No, I think that it takes a little bit of squinting and looking sideways to see the economic reality behind the two different stories, but I think they are threads that pretty easily weave together a narrative of a consumer that is stressed. When we look at the retail sales data, we see consumers are rotating from some of those goods that are being most heavily affected by tariffs and are focusing more on services, things that are less affected by tariffs. We see people hunting for bargains online rather than going to big box stores. If they're moving away from big box stores and they're hunting for bargains online, I'm not surprised to see that they're spending more and that they're using a firm for financing those purchases. Maybe a firm is just replacing, say, the Macy's credit card for laying off some of that spending and instead making up those payments in the future.
Stuart, 30 seconds. We've got an important inflation print tomorrow. Is that the data point to watch out for? Just quickly.
That's the data point to watch out for. It's the Fed's favorite inflation gauge. Core inflation year on year going to remain elevated at 2.9%, despite the fact that income growth is slowing on the back of a cooling labor market. All eyes on personal income and outlays report tomorrow at 8:30 in the morning.